Hi, and welcome to the Macro Show. We talk macro and try to make sense of markets that rally on the news that should Joe Biden become president, that he's going to tap former Fed Chair Janet Yellen as his Treasury Secretary. Okay, whatever works for the markets. I'm your host, Steve Van Meter, and in today's episode, we have a lot of fun stuff. $310 billion of forced selling of equities coming, 13 million people losing benefits. We've got fund flows. We've got record short interest on the markets. We've got economic data, vaccine news, and what the heck is going on with gold miners? Woohoo! Man, let's just get this ball rolling out the gate. JP Morgan estimates up to $310 billion in forced selling of equities by year end. What? How can this happen? Who in their right mind would sell stocks? I mean, they're at their all-time high. Why would you even do such a thing? Well, it's real simple. In asset allocation models, which are very, very popular, pension funds are run this way. A lot of institutional money managers work this way. If you look in your 401ks or employer-sponsored plans, you'll see things like target date funds, balance funds, all of these pre-packaged portfolios. In the rules, say how much stocks and how much bonds they need to have. And every month or quarter or thereabouts, well, if they're not at those levels, they need to get back to them. So let's say you have a 60% equity portfolio and a 40% bond portfolio by rule, and is currently 65% in equities and 35% in bonds due to outperformance or underperformance, depending on which way you want to look at which side of the fence. Well, guess what? They have to sell those equities down, buy bonds. Wait, did someone say buy bonds? Oh, yeah. And that, my friends, is crown worthy alone. So you have $310 billion, which somewhere in this article, it says it's in one of their top quintiles somewhere. Oh, 96th percentile. I mean, how about that percentile? That this is going to be a massive selling of equities going into the end of December. Now, this is real significant because what is the Fed doing? Well, they're buying $120 billion of bonds per month. And I've been tracking, as many of you know, the $80 billion of Treasury purchases from the primary dealers at auction, because it's really easy to track, versus what the Fed's buying. And the primary dealers have barely, I mean, most months they're behind what the Fed's buying. This is the first month that the primary dealers will have a little bit of surplus. Now, some of you have been wondering, well, who's going to buy bonds? Remember what I said? Yeah, you. Those who own all of these, if you got money in a pension fund, if you've got money in a diversified portfolio, some money manager somewhere between now and the end of the year, with some of it occurring at the end of November, the rest at the end of December, will have to sell. And so this is going to put a nice floor under the bond market at a time when nobody thinks that anyone wants to own bonds, which I think is pretty great because $310 billion is a lot. Starts to make sense of perhaps why these commercial banks have been front running this. Do you think they didn't know this was coming? Of course they did. It's really easy to do. Any money manager, myself included, who manages some style of these portfolios, could tell you on a month-to-month basis, yeah, it looks like there's going to have to be some selling of equities to buy bonds. Again, puts demand into the bond market. Gotta love that. And that's coming. How about this? 13 million people could lose their unemployment benefits in December unless Congress does something. Well, Congress isn't well known for that, but if they do something. So these pandemic unemployment assistance, PUA, and pandemic emergency unemployment compensation scheduled to end on December 31st. To make this even worse, because if this news isn't bad enough, and it is, and a lot of people think, well, that's got to be bullish for stocks. Well, all news is bullish for stocks. We all know that. The moratorium on evictions also ends at the end of the year. And if that's not bad enough, and it is bad, it's really bad, because there are already reports from people saying, look, I don't even know how I'm going to make my mortgage or rent payment when that happens. Some of you are going like, look, I already know what you're going to say. It's right. Student loan repayments start next year too. And that's a lot. Some of you have written me and said, look, I'm getting by now, but when I have to start making that payment, can't do it. And, so many people look at the money supply and say, look at all this money on the sidelines that could go into equities. And one of the things I keep mentioning is, remember, there's a lot of people out there that aren't making payments on things that they normally would. Not to mention that, but there's also now 13 million people that are going to have less income to make those payments that they haven't been making. That money on the sidelines was never intended to go into the equity market. People are saving because they don't know what they're going to do if these programs aren't renewed in terms of their unemployment benefits, or if the moratorium is not extended. They don't have an answer. They've been saving money. So this is not good news at all but the markets, of course, it's fantastic news, because why not? Janet Yellen might become the Treasury Secretary. Who knows? Into the economic data, we got a lot of preliminary manufacturing and services PMIs showing slight expansion on both out of Australia. So again, these are month to month. So these are, 55, 56s, I wouldn't say super slight, but it's not the super strong, but it's kind of in the middle. Better than slight expansion in the sectors there. How about we move into the Eurozone? We'll look at French manufacturing PMI flat, no change. Composite PMI down at 40 because the services sector, surprise, when you close down your economy, things do change. So the services sector drops to 38. That is a solid contraction in the services sector. Meaning the composite PMI, which is made up of both manufacturing and services, is also in contraction. How about the German economic machine? Slight expansion in the composite there. Again, we see the similar setup where manufacturing is expanding, services are contracting. How about the broad Eurozone itself? The composite PMI in contraction, mainly due to the shutdown of the services sector, while the broad manufacturing sector is showing a slight expansion at 53.6. We're still digging out of this hole from the virus. Looking at Great Britain, composite PMI in slight contraction, with manufacturing showing slight expansion, services showing slight contraction. Moving into the U.S., we're going to come back to the Chicago Fed data in a minute. Let's look at the U.S. manufacturing PMI, 56.7. Again, all these are preliminary data. I suspect these numbers will come down due to further restrictions and lockdowns that have come out since. But we see a nice, slight expansion here. The services PMI almost pretty, not super strong expansion, but when you start getting into the upper, closer to 60, you start saying, hey, this is a pretty solid expansion. How about the overall composite PMI? Again, solid number of 57.9, showing above slight expansion. But are we out of the hole yet? And the answer is no, we're not. You got to remember, coming back to the data, it wasn't until August that there was no change. So we were going backwards until August. And then in August we had slight expansion at 54, and then in October we had slight expansion, and then November we have slight expansion. We're still deep in this hole. So anybody that looks at these PMIs right now are saying, wow, these numbers are great. Well, they're good because they're up. But does it mean we're back to normal? Nowhere close at all. Now, if you look at the Chicago Fed manufacturer, or the Chicago Fed National Activity Index, you're like, wow, look at that big jump to 0.83. And you're like, well, that doesn't sound like a lot. Well, for this index, 0.83 is a big number from 0.32. Let's take a look at this. And what we see is this thing rose. Now, this is a national activity index. Remember, 0 is expanding as a historical trend. So when you're at 0.83, that's pretty high. I mean, we could zoom out and we're not going to find too many data points like that. But even the Chicago Fed says, hold tight. The month-to-month numbers can be way noisy. Look at the 3-month moving average. And of course, it's good, above 0.7. More than 2 years into an economic expansion is a sign of inflation. Well, do we see inflation? Well, we're at 0.75, which, of course, we haven't been there for 2 years. Now, keep in mind, we've got a long way to go here. And for all those treasury shorts, we've got a short time to get there. And this is not even a bet Smokey and the Bandit would take. I mean, no, they would not take this deal. They would not make that run. No, it wouldn't happen. Wouldn't happen. But we got a long ways to go. And the trend on the 3-month moving average is slowly decelerating month after month. Now, this month's print will help bring that up a little bit potentially, but the trend is down. So, we look here and say, well, not too bad. Not too bad at all. I mean, it's a quite impressive number. I'm not sure I'd buy it, but it's very impressive. Today's auction data, the 2-year note, was met with strong demand mainly by primary dealers. Well, maybe primary dealers have some $310 billion worth of bonds they'd like to sell to somebody. 5-year note auction was not met with very strong demand. Let's take a look at this largest 2-week inflow. Global stocks in history. You were there. You lived through it. Maybe you bought it. I don't know. But there it is, going back all the way to 2002 from Bank of America Global Investment Strategy and EPFR Global. That's pretty impressive when you see that global equities were bought the most at the top, and it did not cause prices to move. In fact, when I look at the markets today, we had this morning we had vaccine announcement, and what did we see in the market? I mean, it didn't move a whole lot. The bond market didn't move a whole lot. And what does that tell you? It tells you the rubber band is stretched. When you have people piling into equities, largest 2 weeks in history, and you can't get the market to go up very much, it kind of tells you you're at the end of the line. And here's something else that tells you you're in the line. This is a great chart from Goldman Sachs and Bloomberg. Record low short sales. Bears are disappearing fast. I know they're certainly not watching this show. The bulls aren't watching this show. Maybe that's why there's just us bears are disappearing fast amid equity rally. And look at that, the short interest, the median S&P 500 stock short interest as percentage of market cap as the end of last month is somewhere around, 1.6%. Maybe 1.55. Go back to 2004, and it didn't jump up from there. So that means nobody is short this market, and you have massive flows. Again, all record flows, not massive, record flows the last 2 weeks. Nobody short the market, and yet the equity bulls say this is the beginning of a new bull market. Bull markets don't begin like this. They begin like when short interest is off the charts, not when it's way down here. Nobody is protected against the downside of this market. Let's move on. Now, our friend of our show, my buddy Brent Johnson of Santiago Capital, he sent me this on Friday because he's cool and has Bloomberg and I don't. And this is the totals, Treasury bond net short position. And you can see he actually sent it to me without me asking. I was going to ask him, and I didn't want to be that friend. We've all got the friend who can't afford the cool tools, so you ask for stuff. I didn't want to be that guy, but he knew I wanted it. He sent it to me. It was very nice of him. And you can see there wasn't much short covering. Now, this data was as of the 17th. So let's go and look at the charts and see where the bond market was on the 17th. We'll go to the 30-year Treasury yields of 17. So as of right here, this little red candle, the small one where the mouse is, all that's moved down from the high of 1.767% on the 30-year all the way down to closing value on that day. Doesn't really matter, but it was 1.626%, was met with almost negligible movement on the speculators. They shrugged it off to the extent. Brent sent me this. He says, look, there's only a change in 2,200 contracts. That is it. Nothing. In the futures market, that might as well be nothing when you have this large of a net short position. So speculators very much believe in their short position, just as the bond king himself is very much in belief on the long end of this market. All right, what do we got next? Let's take a look at Hedgeopia, how hedge funds are positioned. Now, this is interesting to me that hedge funds are moving long the 10-year. It makes no sense. I mean, they're so heavily short the 30-year, right? We see it here. Perhaps this is the bet on the housing market. This is when I'm kind of starting to believe that this is truly a bet on the housing market and a demand for 30-year mortgages. I don't think it's going to play out for them, but there's your bet. And if they're wrong, all that has to get unwound. And you can see here on the Hedgeopia charts, almost no change there either. If you're kind of wondering what's different, is Brent pulls in all of the speculative positions, and where Hedgeopia, he's just looking at one specific set. So Brent's is a little more detailed, and we appreciate that. West Texas Intermediate, we're seeing some bulls back in the oil market, driving oil prices up, and yet supply is really high. I mean, it's really, really high. And a lot of people don't realize that because they're still betting on a massive amount of demand coming into the crude space while economies are being shut down and put under new restrictions. Doesn't make a lot of sense to me, but people are bullish on inflation and on crude. How about equity bulls? No real change here on the S&P 500. The euro continues to slowly move back down. Remember, in the trade-weighted dollar, the euro is the second largest position. So if you see these speculative positions continue to back off and the euro head lower, that means the dollar's headed higher. And what else? If the dollar's headed higher, good chance gold is headed lower. And boy, we'll take a look at that. I feel sorry for, my heart goes out to many of you gold bulls today, especially those in the mining space. I get your pain. I totally understand it. But expect that if you see the euro start to back off, that these speculative gold longs are going to move down too. How about the NASDAQ? Well, we're seeing a little pickup in the short interest on the NASDAQ from speculators as tech stocks lag the broad equity market. And look at the Russell 2000. I mean, crazy movement in small caps as everyone's piling in to the Russell 2000. Wild. How about the dollar? Still net short on the dollar. No major change here. Remember, the longer speculators are on the short or neutral side on this, which they are, the more likely the dollar goes up because they play chase on the dollar upside. And no real change in volatility. And all this is telling you is that speculators do not believe there's any risk to the downside of the market. And that is validated in this chart here, where again, nobody is taking out any form of insurance, whether it's a short side of the equity market or on the volatility space. Nobody is doing anything. And yet that's usually where reversals tend to start to happen. Pretty crazy. Again, coming back to S&P 500, record 2 weeks of inflows. Can't even get, we did have a new all-time high, but we're still below that now. Treasury yields still headed lower today, up slightly with TLT just closing over its 50-day moving average. I know it's very important to some people that anytime it gets over and stays over its 50-day. Remember, rallies begin with a cross over the 50-day and a reconfirmation. So, this is an early trend change potentially for the bond market as I expected it to be. Taking a look at crude oil, I'm just kind of wondering what the reports for the next couple of weeks are going to say, because there's a lot of people are bullish on crude, and the data on Cushing, Oklahoma, which I tried to find for the show today, I couldn't, says there's a lot of inventory there, a lot. How about the dollar? Almost broke down. I'm sure the dollar bearers were very excited until it popped off that 92 level. Remember, some people say from a technical picture, if you knock on the door enough times, you go through. Here's the other side of that story. If you knock enough times and the door is locked, price is going higher. All right, what else have we got? Oh, yes, the gold mining stocks. I expanded this channel down to make everyone feel better who's bullish on this. I get your plight. I totally understand it. But this is a red flag. If you see gold mining stocks or gold moving down, which you see here, that is a red flag for the broad equity market. Keep that in mind. From a perspective here, which we did look at on the Sunday chart show, there's some support here, right around here at current prices, a little bit more support there. Reality is this thing could easily get back to its pandemic lows, and that would not be a good sign for the broad equity market at all. Be sure, as always, my fans and friends, be sure to like, subscribe. I love all of you, whether you agree with me or not. That's not a requirement of the show to disagree with me. We're here to learn macro, and I've tried to make sense of the markets that, how can we do any of that? I'm your host, Steve Van Meter. Thanks for joining me today. We'll be back on Wednesday for for the pre-Thanksgiving special. Hopefully we'll have some interesting stuff to talk about. And if the markets keep up like this, we're going to have some interesting stuff to look at. Bye now. The content of this video is provided educational information only. Is not intended to provide investment or other advice. It is not to be construed as a recommendation or solicitation by or selling security, financial instrument, or participate in particular trading strategy. This video was prepared by Steven Van Meter. Personal capacity to express this video that I'm doing not reflect the view of Atlas Financial Advice Inc. or Steven Van Meter Financial.